Start record. Let's start recording.
Well, it is top of the hour. Welcome, everyone. I'm Jeff Finkel, CEO of the Arcview Group, and thank you for joining us today. I have to say, I'm really excited about today's program. This is valuable information about the most difficult financing round to raise, your first. We have a great group for this discussion, and as I set the stage today, let's start out by just taking a few seconds to complete the poll, which is about to pop up on your screen. Now, many of you have been part of the Arcview community since it started back in 2010 by Troy Dayton and Steve D'Angelo. And their mission was to create really a first of its kind and much needed safe haven for both investors and entrepreneurs, and certainly with social equity at its core. They were appalled, and we remain appalled today, at the stigma still surrounding the cannabis industry and the related social justice issues. We just, at the last part of last year, hosted two power-packed Arcview in-person events, our first since COVID, so before February of 2020. One event, New York City in October, and one in December in Miami, our 49th and 50th. They were really extraordinary. You know, I think we were really proud to have created a new signature sort of set of sessions for entrepreneurs and investors. The first putting institutional investors and super angels on our stage in a reverse pitch format. And then a second one, which was an Ask Me Anything session, which was sort of a safe place to ask investors questions entrepreneurs have, but sometimes they're too intimidated to ask. And that went really well. And then, of course, we followed up with a terrific slate of companies in our Planting Seeds pitch event. And we're going to do more of this. We're going to create more in-person events, focus on investing and financing needs, bringing the industry's most credible and experienced thought leaders in that category. So stay tuned for future announcements. And we're also going to continue our digital webinars like today, because, hey, we all want to keep learning. And there is so much to learn, as this is, as you all know, a complex sector to navigate. Now, as most of you know, we also operate a venture fund. So we look for companies at the early growth stage, so ideally post-revenue. And we are also open to putting together special purpose vehicles made up of investor members of our community. So please be sure to connect with us if you're interested in that. And a key part of our ecosystem is our consulting group. They provide a number of practice areas: business planning, investor presentations, cultivation facility planning, brand expansion into other states, brokerage services for used equipment, and license pursuit. And we're about to launch a service that's going to help companies restructure and, if need be, wind down comfortably and efficiently outside of the court system. So to learn more, go to www.arcviewconsulting.com. I think we're going to put all of the links to our ecosystem in the chat shortly. I also want to draw our attention to our marketing services group, and they offer a full range of services, including branding, collateral, website development, lead gen, strategy, and a CMO to go service. So if you're interested in that, you can click on the link to marketing services. And lastly, check out our library of our impactful programs and industry thought leaders. All of our content seen by over 36,000 people that have registered for Arcview Access digital events since 2020. So we're going to put that in the screen shortly. So you have all of those contact links. Now, before we move on to our programming, I just want to take a minute to thank our strategic alliance partners. The first is Green Tank. They're a provisioner of innovative vape hardware. PayQuick, which offers treasury services for cannabis licensees they're about to complete their merger with GreenCheck Verified. SuperNet, a closed-loop credit card services for cannabis dispensaries. and our data partner, Hoodie Analytics. We appreciate their support and we honor their place in this ecosystem and community. Okay, I'm excited to get going here. As I said, the first round of funding is the hardest to raise. Now, ultimately, if you can self-fund, that is best, but not all entrepreneurs are in that position. So you usually rely on your friends and family. So I'm wondering if anyone in the audience has a rich Uncle Stanley. Well, guess what? I do. He was an orthodontist. He's retired now. And I never asked him to fund anything, but I was comforted to know that I probably could. Now, I don't know if he would have funded anything I was involved with or would have said yes, but I knew that I had him and that gave me comfort. But what if you don't have a rich Uncle Stanley or other friends and family members that can ka-ching? What do you do? Well, that's what we're going to learn today from our knowledgeable panelists. So let me start by just a brief introduction of them, and they're going to give you a much deeper background on who they are. The first is Christina Lopez Aducci. Welcome, Christina. She's the founder and CEO of House of Puff. She's raised friends and family, so she'll be interesting. The second is Jen Pyro, a super angel and member of the Arcview Collective Fund. I wish Jen was my Uncle Stanley or maybe my Auntie Jenny, but we'll hear a lot from her. Michael Mitgang, Managing Director of WGD Capital, an early stage fund investor, and Oscar Joffrey, CEO of Core Connect, a leading online fundraising tech platform. So let's have you each give a proper intro. Let's start with you, Christina. Tell us about you.
Thanks, Jeff. Hi, everybody. My name is Christina Lopez Aducci. I am the founder and CEO of House of Puff. We are a cannabis lifestyle brand based in New York, and we leverage the power of art to make cannabis consumption chic, easy, and welcoming. We sell D2C and B2B, and our big content marketers. We have an editorial site, our YouTube channel. So not only do we sell beautiful objects, but we believe in the power of education and normalization of this plant.
Thank you. Auntie Jenny?
Hi, everyone. Jen Pyro. I'm an angel investor. I started out doing this in tech back in 2016 and transitioned mainly to cannabis and psychedelics. And I'm really glad to be here to talk about the state of fundraising in 2023.
Thank you, Jen. Michael?
Thanks, Jeff. Great to be here. Thanks for inviting us. Michael Mitgang with WGD Capital. We have a dedicated fund focused on investing in the cannabis sector. Our primary focus is on the ancillary side of the business, so tech-enabled IP-related opportunities. I'm based in the San Francisco Bay Area. I have a partner who is based in Vancouver, British Columbia, and another colleague who's based in Israel, and one more, an intern that's working with us out of New York. We currently have 8 companies in our portfolio, and hopefully within the next week or so, we'll have our 9th.
Terrific. And Oscar?
Thank you. Good afternoon, everyone. My name is Oscar Joffrey. I'm one of the co-founder and CEO of Core Connects. We are a company that helps cannabis companies access capital from the general public. Since the introduction of the Jobs Act in 2012, the Jobs Act regulations have really changed the playing field of how you can raise capital. Just to give you an idea of that, in 2012, all the capital raised in the United States was purely one regulation, 506B, which was the rich uncles, and that's it. The last numbers that just came out for 2022, $4.45 trillion was raised in the private markets. The general solicitation regulations, which came under the Jobs Act for the very first time, superseded over 50%, which means investors are engaging with companies to raise capital online, and we provide the infrastructure, the compliance partners, broker dealers, auditors, lawyers, so a company in the cannabis space can transact.
Terrific. Good stuff. All right, let's get going. Christina. So apparently you have friends that ka-ching. So tell us, I'm sure our audience is interested, what it was like to raise money from friends and family. Like, was it comfortable?
Yeah. I have to say, I really enjoyed the process. It was my first time fundraising. It was my first time really putting together a proper deck. So I used friends and family as sort of a warm up because I knew down the road I did want to go for some VC and PE money. At first, it was great to get feedback, right? Because your friends and family, they are not shy about giving you feedback. And I thought that was great. I was open to criticism, especially on my first few decks. They were like my mom and my rich uncle Stanley, gave me advice on how to improve my pitch, improve my deck. So every little tweak excited me. I had a few false starts. At first, I wanted House of Puff to be one thing and then another. I wasn't very clear. So I say to folks who are thinking about fundraising friends and family, even though they are your friends and family, you've got to be clear about your goals and needs. Even before approaching them, be ready so they can invest in your business. Be clear about what you're looking for. So at first I was sort of wishy-washy and then found my sea legs. And then, I quickly realized as I made my list of friends that I knew probably had some extra capital in their pockets. And this was last year. So the economy started going down a little bit. So I knew I had to be quick about it. Not many of them knew about, the total addressable market of cannabis and sort of what I was selling them on. So, I had to really educate a lot of folks about cannabis because they didn't have the same level of expertise or experience that I did, and I had to be very transparent. Right, this is cannabis. This is still, even though I'm ancillary and don't touch the plant, I still wanted folks to be educated about the industry and the risks involved, and set realistic expectations about the potential of returns. And probably one of the things that I was most uncomfortable, if I had to pick one thing, wasn't the actual pitching. It was the organization. Like, I come from an art background, I'm a creative. So Excel sheets sort of scare me a little bit. Organizational tools like Trello, tracking who was warm, who went cold. That was sort of a learning curve for me. But I quickly realized in order to have a successful friends and family round, you have to stay organized, you have to track your progress, and you just have to set some measurable goals and metrics.
I'm a big Trello fan too, by the way. But you know what my takeaway from that answer is? Treat the process just like you're going after institutional investors. Be buttoned up, understand how you're telling your story, set context, don't assume people are at the same starting point with you, and organize it like a professional raise, even though your target are people who know you. And I think that that's a really good takeaway. When you did it, did you do it in a group, or did you sort of do one-offs? Did you sort of have meetings with the one-off friends? Did you say, hey, everybody, 2:00 on Tuesday, I'm having cocktails at my house, come and hear about my new thing?
Yeah, no, I actually took an individual approach. I almost wanted to trick my mind and act like they weren't my friends and family. Like, I don't know you, Mom. I wanted to make it feel special. Again, even though I knew these people, most of them very well, it was important for me to treat the fundraising process with professionalism, right? Be organized, follow up promptly. Like, yes, my mom was one of my friends and family and my rich uncle Stanley, but I still followed up.
Do you really have an Uncle Stanley?
No, I absolutely do not. But I have a rich uncle. His name isn't Stanley, though.
Okay.
But it was important to be organized, follow up promptly, answer questions or concern, and communicate regularly. But I felt for me, it was an individual approach. Sometimes it was, it was one-on-one in person. And then there were a lot of people on my list who were in different time zones. So little by little, I would send videos of my pitch to them. And that was also a cool trick that I learned, that I couldn't be everywhere at once and stack everybody in my day. So I made pitch videos, which went well.
Was it uncomfortable to get a no? Was there other things wrapped up in the no above and beyond, this doesn't make sense for me as an investment at this time?
Yeah, I think you were one of my early no's, Jeffrey, if I'm being I kid. I'm not kidding though. I was prepared for the no's. I think a no is tough for anybody, right? You're gonna get no's in business, especially in cannabis. And I quickly realized that not everybody was interested in investing, and I was fine. But what I did was I used that no and I used those rejections as an opportunity again to refine and my strategy and my pitch and kept it moving forward. And I think that the best no's can sometimes be the best thing for your business.
Now, do you worry about the relationship and will it survive a bad outcome or a good outcome? Is stuff wrapped up in that above and beyond it, sort of an arm's length institutional investor?
Yeah, no, I wasn't too worried. I think it is important to always remember, while, friends and family fundraising is a great way to raise capital. Yeah, it can put your personal relationships at risk. It didn't for me. I made sure of that. That was a high priority for me. So I was very mindful of the potential impact it could have on my relationships and prepared if there were any kind of conflicts or concerns that would arise, that I would meet them dead on and just be brutally honest. And so I think when you're transparent, you sort of can navigate away from the messiness of it all.
Well, I would say congratulations to you, because you seem to have been successful taking the emotion of the pre-existing relationship out of play by treating it professionally. So I think that's great. I think that's great advice. Let me just ask you if there's any other one thing that you might suggest to the audience to be aware of, be careful of, or a best practice as you're doing this, other than the very good one that you've given us already.
I think two things. I think you have to be adaptable, right? You have to be adaptable and willing to pivot, especially in cannabis. The cannabis landscape is changing quickly, and it's important to be open to new ideas and opportunities that can help your business grow. And then the other thing is celebrate your successes, no matter how small they are. I got a $2,500 check from my aunt, who probably shouldn't have written me a $2,500 check. But that was a win for me, right? And, fundraising, as we all know, can be challenging and stressful. So take the time to acknowledge and appreciate each milestone.
Understood. Thank you for all that. That's really great stuff. All right. Look, those without a friends and family network, what do? Right? Maybe you turn to somebody like Jennifer or somebody like Michael. So let's learn what's important to you guys. So Jen, let's start with you. You're a super angel. Again, you were in tech before exploring the cannabis sector. Let me try to understand your strategy and how you think about it. There's a lot of different strategies to angel investing, right? One is small checks in a lot of companies. I call that the spray and pray, and then just figure out which ones you're going to double down on. There are other strategies that are a more meaningful check, and then one and out, like I'm not following on, but I'm going to bet my 150, 200K, 50K on 15 companies, and that's what I'm doing. I'm not following on. What is your strategy? How do you think about your, putting money to work as an angel?
Yeah, so I've been doing this for about 6 years, and I think my strategy has changed pretty dramatically from that. Early on, I wanted to get into a lot of companies, place a lot of small bets, and then do a lot of follow-on. And now I'm being a little bit more selective about where I play, and especially based on kind of who else is in the rounds. Because as the landscape changes and VC money becomes more and more important as you're raising more and more capital, bigger dollars, it's really important for angels to kind of be along on the ride for that. And I think that's been a big change over the past few years. It's really important that we have alignment, that we understand where the founders are going, and kind of depending on what their strategy is, whether it's acquisition, where they plan, from the very beginning, we want to be acquired by a bigger brand, or if they want to take it all the way to IPO, that definitely kind of makes me think about my check size and how long I want to stay invested in something. I assume everything is at least, looking at 10 years, maybe from startup to exit. So these are very long-term plays. And now that I'm kind of halfway into this cycle, I'm definitely thinking about it a bit differently.
So it's interesting. One of the first things you said is it matters to you who's next to you on the cap table in your round. You want to see some small seed funds, maybe like Michael, or ones, at least people with deep pockets that can support this company, because look, ultimately, most are going to have a hiccup, right? And they're going to have to do a down round, a flat round, get more money in, sometimes on short notice. So that's important to you, right? Who's next to you?
Definitely. And in cannabis, it's especially important because the capital is more restricted. There are a lot of funds that can't touch it because it's still considered vice. There's a lot of individuals who can't touch it because of their professions or their jobs, or they can technically invest in it, but they're a little scared to. So it narrows down your pool of investors. And then it becomes much more important to know who's kind of with you on this ride, and do they follow on? Is it going to be impactful enough? And cannabis is pretty capital intensive right now. I don't think anybody's ever joined this industry and then been like, wow, I didn't spend as much money as I thought I would. Like, it's really hard because the laws are constantly changing. You have to keep in touch with everything that's going on. You have to be really preemptive about what might change locally, federally. So I think that amount of capital that's necessary is kind of, top of mind of, sure, this is the first time you're going to raise capital, but it's not the last. And I know you're going to have to bring on bigger investors after an angel round. So I definitely want to know, who are you thinking of approaching? And, does my thesis align with theirs? And, it's definitely getting more and more interesting than it was a few years ago, but I think it's good for this industry to have a bit of a shakeup and to have different avenues. Like, crowdfunding wasn't even an option for cannabis companies a couple of years ago. It's a big change, and I think it's great to see because everybody's going to need all the capital they can get. And I think more and more people are going to be taking a layered approach of, you can't just go after angels or just go after friends and family or just go after crowdfunding. You're going to have a strategy to hit everybody in this life cycle, because one way or another, if you start raising capital in this industry, you're going to keep raising capital until you sell your business.
Yeah, good stuff. Michael, how do you feel about coming into a round that's maybe after a friends and family round? Are you worried about a lot of names on the cap table? Are you worried about that some of them might not be sophisticated? How do you think about that? Does that sort of enter into the calculus to go forward?
So before I even answer that, I just want to comment that we've actually gone through a friends and family round ourselves. In putting our fund together, we're entrepreneurs just like Christina and everyone else that's out raising capital. And when we raised our fund, there's no traditional institutional capital that we can go knocking on their doors to get access to. So our investors, our LPs, our friends and our family and people that we've done deals with before in the past. So we carry similar burdens to companies that are out raising friends and family capital in terms of, we want to make sure that we're investing in companies that we believe are going to succeed. And because we don't want, the last thing we want is for any of our LPs to be losing money, because they are personal relationships that go back a long time.
Yeah, no, the same in the Arcview Collective Fund. That's what it is. But do you worry about when, let's say Christina comes to you and there's, I don't know how many friends and family she has. She looks like she has a lot of friends, to be honest. But is there 25 people on the cap table in a prior round that all kind of have to vote to approve something senior? Like, how do you think about that? Does it affect the way you look at it?
Yeah, oftentimes not. What we look at more is the fundamentals of the business. The fact that there is friends and family in there that have supported the company, that keeps the CEO motivated and aligned. I think those are really positive aspects. What's important for us whether it's a friends and family round or another round that's coming before us, is what terms are there? What controls or protective provisions or other aspects of a deal that as an institutional investor, we're looking for that a friends and family investor may not? I think a core difference is a friends and family. If I'm writing an angel check into a company, that's just me taking my own capital, putting it at risk. As a manager of other people's money, I have a higher level of fiduciary responsibility to those investors. So my level of diligence, the types of terms that I might require in a deal are different than I may require as an individual investor writing a check. So we're not that company is ultimately going to need to raise additional capital. If they don't, they're probably not talking to us. So we're not generally concerned whether or not they're going to get the shareholder approval to raise that capital. I'm not familiar with a situation where that hasn't happened. It's more about what our involvement will be, or our syndicate of institutional investors will be in that round or in that next round and going forward.
Let me direct these next two questions to either you or Jen. Actually, anybody can answer. This is sort of off friends and family specifically, but just about, how companies should think about approaching their raise. So how should companies think about how much to raise? Now, look, when capital markets are down and there's uncertainty, raise as much as you can. Don't be valuation, sensitive, as the market will quickly tell you. But what are the kind of good guidelines for companies, at least in your mind, about how much to raise in each round?
So from my perspective, we're telling companies that either we're involved with or that we're looking at investing in this market in particular, you need to have 18 plus months of runway, preferably 24. There's too much uncertainty out there. The number of funds that are available to provide capital to this market is unfortunately not getting bigger right now. It's actually getting smaller. And I think it's critical to know that you've got that capital. From a fund perspective, we also want to know that we're writing a check into a company that's got that runway, and that we're not back at the table in 3 or 6 months going, what do we do now? And raising capital takes time. So even if you have 18 months of capital, you need to start thinking about what milestones you will have achieved over the next 12 or 13 months, because you need to be getting ready, getting your ducks lined up at month 12 or 13, assuming it could take as much as 6 months to raise that capital. And you don't want to be on fumes when you get to month 18. So it's really important to have that kind of runway.
I want to underscore that last point is critically important. You have to figure out the inflection point that makes you interesting to a follow-on financier, hopefully at a big markup from your prior round, and have enough time. 6 months is about right to be able to get that done. So if it's 18 months, you're going to run out of money. You're exactly right. Month 11, month 12, you have to hit a goal that makes you appealing to start the process. That's really important. Companies don't often think of it that way, but I think that's really, really good advice. Jen or Oscar or even Christina, from the standpoint of the goals you're setting, anything to add to that?
I would say, I'm sorry, Oscar, go ahead. Oh, thank you. I would just say that if you had asked me this question 3 years ago, I probably would have said 12 to 18 months. And I think that's what's still written in a lot of blog posts when founders are looking for information. But I think, like Michael said, things have changed dramatically. And I think that number is now more 18 to 24, which is, different advice than we were probably giving people a few years ago, was raise less and go back to the market. And now it's raise more and get heads down and build to get through, this next wave of uncertainty. Because not only are we facing just the general economy, we're also facing kind of what's next in cannabis, right? Is it going to be more state by states to tip it over? Is it going to be federal action? And since I think no one has a crystal ball on what's going on there, it's really crucial that founders can go back and build and get their sales up and become revenue positive and really start to show that growth story. And you can't do that if, like you said, you raised money and then 3 months later, you've got to go do it again. It gives you no time to build. And as a CEO, you're expected to do both at the same time, which is really, really hard. But the more cushion you can give yourself right now, I think that's the best thing you can do.
Oscar, anything to add?
All those points are valid, and I'm so glad that the Jobs Act was introduced in the United States, because if the only choice you had, we'd be in doomsday today. So I do agree that companies need to plan their capital raise from a timing perspective. 1824 is at the very least. I'm 100% But there's a fundamental question companies, when they're raising capital, that they're not asking. And this took me many, many years to learn, which is, what does money represent? And I think we all think of money, we need the money, but what does it represent? And there are two, money wants it to work and they want to get a return, and there may be other things, but what does it represent for a company? What do you want it to do for you? What are you prepared to give up for it? It's not just a percentage. So you have to balance that into what path you're going to take in raising your capital. I think those are the considerations that most entrepreneurs today are making the biggest mistakes on. They think they want venture capital, private equity, but they have no idea what that is. They have no idea that it's not just a percentage. They have no idea the control. Today, we're seeing the highest levels of bankruptcies in venture-backed companies. Why? Because that decision was taken out of your control. The VC said no more, boom, you're done. That's it. I'm seeing that. So if you're honest with yourself, the type of individual you are, and then you can walk down the path. Look, I'm an entrepreneur just like all of you. I'm Canadian. So we always raise, 100 times less than you do, and we have to make $1 worth 100. And we do it. Don't ask us how, but we end up doing it. And the other thing we get taught very early on, that if you don't get venture back, you're not a good company, which is bogus. I mean, it's a total, lie to everyone. And what I've learned over the years is that the more I went down the path of the Jobs Act and using it, I ended up attracting private equity, but under my terms. I knew what I wanted them for, because they do have a role. Michael could have a role where he comes in with additional capital, but it's not just capital. Capital is such a small part of everything we all need. So you got to put capital requirements and everything else and be honest about it, because once they get there, they're going to put those things in. So those are my observations, because I see, look, at any given time, I got 400 or 500 live offerings raising capital. And I see it from the junior one who's got an eagle up here, and to the one that is, they've been around the corner a few more times, and they're taking it step by step. But there is one thing that they all have in common. They're learning about money, and we're teaching it to them the same way it was taught to me, to make sure that you understand it correctly. So when you go down the path, you know exactly what you're getting into.
Yeah, great stuff. I mean, look, it's about recognizing that you're giving up more than an equity percentage. You're giving up some control, which are, outlined in your deal docs. And that, quite frankly, not all companies should raise venture. That doesn't mean they can't use outside capital, but some don't meet a venture capital characteristic. And then thirdly, I think what you're saying is VC is not don't make it the vanity metric. In other words, you haven't arrived because you raised 5 million from fill in the blank VC who's prominent, right? That's just the step along the way. The goal is revenue growth and exit. Someone once asked me, what's the best thing a company can tell you during a pitch? I said, without even losing a step, 100% month over month growth.
And
I don't care what you do.
It's this is just a step along the way. Our tagline is guiding companies to liquidity. And whether you're raising a friends and family round, whether you're doing a venture round or crowdfunding round, or quite frankly, even if you're doing an IPO, it's a step to an exit, because even at an IPO, that company does not have the liquidity for the founders. They're locked up, and they got to get through at least 2 earnings cycles before they're gonna begin to get out. So this is just a milestone along the way, and I'd say whether it's a venture group or or crowdfunding, it's important to also think about who those partners are and the value add and relationships that they can bring, because you're right, it's not just about money. You could have a friends and family investor who's just going to be calling you every day, every week, what's going on. And I had expectations that I was going to be out in 6 months or 12 months. And that's not the right partner for you either. It's about managing expectations. It's about having the right partner at the table that can be helpful, and one that can be patient and support you along the way.
Let me ask one more question as it relates to friends and family and structure before we move on and do a little bit deeper dive in all that is online fundraising. We used to call it crowdfunding. It's now much broader with Oscar. So let me just ask, probably Jen and Mike, maybe more Mike, but either can answer. Any advice that you would give companies that are raising friends and family from a structural point of view that might relate to attracting your downstream interest or making it awkward for you to invest downstream? Is there anything structural that sort of knocks it out of the park for you either way? Like, for one example, I saw a friends and family deal. It was a convertible note, but they didn't have to vote as a group. So you had to get the consent of every person in the note to change the terms of the note or to extend maturity rather than the majority of the note, right? So that's kind of a mistake, because now you got to go after a lot of individuals who may not, it's not that they're not necessarily intelligent. They just don't have the experience to know how to respond to some of those requests. So that's one thing that comes to mind for me, but is there anything else that you would say that you would not like to see or like to see?
Jeff, I think that one's a really good point. I think you don't want to find yourself with one or two investors being able to hold out and try and extract value at the 11th hour. That puts the company in a precarious position. The other thing that I think is important, and whether it's a friends and family or even doing a venture round, is it's about trying to put a plan in place that unlocks value over time, because your friends and family may not dig in as much to a deal and not understand the business or comparable company valuations the same, or deal term specific things that an entrepreneur might be able to put in, or they might be able to get a valuation that's higher than they might otherwise get from an institutional investor. And so I think what's important is you want everybody to win along the way. And so I think setting fair terms with friends and family is important, so that when that next round comes in, hopefully it's at an up round. But if you set it too high, particularly in this market, you're going to struggle to raise that next round. And so setting it at a fair value, and I can't define what fair is, depends on the company and their specifics, but setting what I quote a fair value, so that when that next round comes in, they're seeing upside and they're excited, and they may even choose to put a little bit more capital into that round as well.
This is going to be really important to investors like us, as companies, many of whom are reaching a distressed state, whether we're existing investors and go back in, or we're looking at a new deal. There's this temptation to structure terms that are very favorable to the investors at the expense of the entrepreneurs. And the comment I would make is you have to have an understanding of the whole pie, because without motivated founders, that business is not going to succeed. Many, many years ago, I was an investor in a company. I was the only one supporting it. It was very early on in my career. And I put in a facility that had a 3x liquidation preference. Now, I'm not going to explain what all that means to everybody, but let's just say those terms are very favorable to the investors and very draconian to the entrepreneurs. And what I realized about a year and a half later, as they were scaling, is all of these founders were now behind so much capital before they would even participate in an exit. And I proactively restructured it with them in mind to give them a piece. But I guess what I'm saying is you talk about fair deals, and this is going to be really important in 2023 and 24, and how we look at these companies that have had a hiccup, and we're definitely putting risk capital in, but how we make sure we get the requisite return, but that also motivates the employees. And that's going to be pretty tricky. All right.
Yeah. One thing important to me, I like to see standard terms. I don't like when things are wonky. Like there's a bunch of, this is what a convertible note generally looks like. This is what a safe generally looks like. And when I run that through in Microsoft Word and say compare changes, and I see like 12 or 15 highlights where the founders have gone in and started kind of doing strange things with the terms, that's always a red flag for me. It's like, why? Why are you doing a 3x liquidation preference? Why are you putting in this clause? Why are you doing this? Like, it makes me uncomfortable. And I think for some of the reasons Jeff and Michael are saying, like, I know that as an angel, you're going to raise money after me. And I want to make sure that everybody is taken care of in that chain. I don't want to see founders giving up 50% of their company in an angel round. There's no more company left to give up later to raise more institutional money. I don't want to see founders, putting in terms that are like super bad for them. That makes me question, like, do they understand this whole process? Do they understand what it means to go on and raise more capital after me? So I think the more you can stay closer to, those documents that were kind of born in the fire of Silicon Valley, like, they're good documents, and you need to have a really good reason to start changing terms so early in seed fundraising. Because if you have a great reason, please tell me. But if you're just like finding things on the internet, or you heard somebody say something on a webinar once and you throw that in there, your friends and family might not know what all those are, but everybody in the downstream is going to, and you might get a no simply from having, documents that just don't make sense to us, when that's an unnecessary no because you change something, not realizing those downstream effects.
Yeah, I would just say I've seen more structured deals in the cannabis industry than I ever did in tech, and I agree. I like the NVCA, the National Venture Capital Association forms, the Series Seed forms, the Y Combinator. They have all the traditional ones because they've been tried and true. Certainly there's small things to negotiate, amounts of the debt you can get without consent, but the structure stays the same. All right, let's move on, because this is really a fascinating area that I think is going to be really important in our industry, which is online fundraising. So Oscar, let's get you a little bit more involved here. Tell us about online financing. What's the sort of general 101 that people need to know?
It's been happening for 100 years. We've
Before there was an online?
And well, before there was the internet. I think this is the part that, when I first wrote the book back in 2011 with David Wield, is that a word was constructed to describe how it would be done on the internet, and the word crowdfunding emerged. And it's regrettable that that term got associated with the GoFundMe's and stuff like that. And I'm not here to talk about any of that. So hence the reason that the ecosystem uses the term online capital formation, which is, if you heard Michael speak, that's exactly what he was doing to raise money from his funds. He went to people he knew. He raised, how did he do it? Via email. What did he do next? He got on a Zoom call and he did a presentation. Now, I'm going to take that and multiply it by 1,000 times. So instead of doing an email, you have a website. And instead of just having a Zoom with 10 people, you can have 1,000. How about 10,000? And that is what the Jobs Act allowed us to do. And also today, Michael is restricted who he can online capital raise with. He's going to family and friends. Online capital formation allows you to raise money from anybody over the age of 18 who is legal of age anywhere in the world. So that means that you are reaching all the cannabis lovers everywhere around the world who have a vested interest in this sector. And there are lots, UK, Germany, Europe, everywhere. They're there. They just never had a chance to participate. So the US is the only country in the world that actually opened that up. And so online capital formation today is fully compliant. There is a FINRA registered broker-dealer that sits behind the scenes throughout the process. They're responsible for vetting in the company, vetting in the investors. The offering is compliant with the SEC. So, and investors, I know the cannabis companies that are here, there's 89% of you that are raising capital. Your businesses probably can't take credit card. Well, guess what? Because the SEC approved you, you can use credit card to make investments. So that means investors can come to your company, put in $500, $1,500, $2,000 in your company using a credit card, and, where your day-to-day operations, they can't. It is that well regulated. So it's exciting. It does take a different form for people, where people get concerned. I've heard Jeffrey talk about, are you concerned with the number of people on your cap table? You shouldn't be, because today, if you're able to raise your capital online, you clearly have the tools online to manage all this. So today we manage one particular company with an excess of 1.2 million privately held shareholders. But the
Wow.
company doesn't call them shareholders. They call them punks. And the company does
To
not
their face?
to their face, yeah, they do. They're called equity punks. And the company calls them that because they are brand ambassadors. See, there's
Yeah.
a very different narrative to all of this. I mean, I've attended your events in New York, and to see that kind of people, that community coming together. I went to Boston to another event. The cannabis sector has a community. Well, just so you guys know, 99% of them can't participate because they don't qualify under the rules for accredited investor, either in Reg D or and so on, or in Canada 45106. Well, guess what? With the regulations that Jobs Act offers, you can set up a booth at these events and say, hey, I'm selling my shares. You can invest $50. And so this is something that when people get their head around it and they go, well, that's a lot of people to manage. It's not. And you don't need to worry about follow-up rounds. People are saying the venture capital is scared. No, they're not. They're not scared. Right now, they're temporarily out of order. You need someone that you can go to access capital. And just as I said earlier when I got started, $4.45 trillion was raised in the United States and the private capital markets. The other number you should know, 1.2 trillion, was only raised in the publics. Our sector is growing 6 times, but the online capital formation now represents 52% of that. Just so you know, 10 years ago, we were at 0. And that is the momentum that's happening here. People are going online. They like it. It's kind of gamification.
So the idea here is that Reg CF, right, which is the regulation this falls under, allows unaccredited investors to fund, and that the amounts it can fund can be as little as up to the company $250, $500. And so what you're really doing is backing the brands that you like, right? Which
Yes.
sort of changes your relationship with the company to be an ambassador, but you got a little bit of money at stake. So that's kind of cool. So now the universe of people can fund your company goes from this in this current capital markets to pretty much unlimited. And that's the real value here, right?
Well, and if you do it right, like I've had companies, they use Reg CF, they raise 5. Then they use Reg A, they raise 75. That's right. The regulators gave you 2 regulations.
Yep.
One maximum of 5 million every 12 months. That's right. So every 12 months you can go back and reapply, boom. And Reg A, you can raise up to 75 million every 12 months. And if you do it smart, you can bring them together. Companies like Moxie, Cowboys, other cannabis brands that have tapped into this, Gage, I mean, what was it? $65 million. It's the way the market can participate. It's unfortunate right now that what the cannabis sector is not able to do is incentivize the buyer with a product, but you can incentivize the individual as well to put in more capital. So one particular company we had, the incentive was if you invested more, they would give you more bonus shares, or it would be a free trip to go see their warehouse. So you can be very creative. And I just need to be very clear, fully compliant with the SEC's blessing and endorsement that you can legally do this. None of what I'm describing is illegal, nor is it offside with the securities regulators today in the United States.
Understood. So we got about 13 minutes left. I want to leave a little bit of time for questions, but I do want to ask you about the type of company that can be most successful on online capital raising, attributes, maybe type and stage. Can you just give us some kind of insight to figure out who is really the sweet spot for this method?
So the sweet spot for this method has nothing to do with the company. After all these years, I always thought it was the company. It's not. It's the CEO. If the CEO from the top down cannot see the value of the crowd, that's no matter how good it is, it's never going to work. So this is the time right now when that thesis is actually playing out. So there's a high demand right now by venture capital companies seeking capital, not just in Canada, everywhere. and they're scrambling. And they're going, hey, I heard that I can use Regulation CF. I need $5 million. How quickly we can get you going really quickly. But are you ready? What do you mean? Well, you need to present to the crowd. No, I don't want to do any of that. You're not. So it's no longer about the company anymore. Anybody can use it. We've seen real estate deals that, my God, they're boring as heck. And yet they're raising $60-70 million. People say, well, that's easy. No, it's not. It is from an accredited investor, but now when John Doe is only putting $500 on a 4% coupon, what is that? Nothing. So it takes a very different mentality. So any CEO listening to this, if you are ready to embrace your customers, your crowd, your community you're building for your business, whether you're touching the plan, not touching the plan, whether you got a store or anything like that, and you know what it takes to build that community and you embrace it, then you're ready for it. But if you're not, if you want to be the CEO sitting in the back office and someone coming to your office and to give you some terms and all that, this is not the right regulation for you. Because that's exactly what the expectations. And this is my 14th year into the Jobs Act. David Will, the father of the Jobs Act, former vice chairman of NASDAQ, when I drank that juice 14 years ago, it changed my life forever in capital raising. And my excitement towards the regulation is the same if it was then. Now it's real. I see it every single day. I see the successes, the failures. The failures are the ones that go, hey, I'm a multi-billion-dollar CEO. Here's my Mercedes Benz and so on. And you want Christina to give you $1,000. See you later, right? It's the humble CEO. They want to know, what are you doing? What are you doing to change the world? It's a very different mindset. That is for a different audience. That's where you go to Jeffrey, his venture capital firm. Hey, Jeffrey, my last company, I did $1 billion play. Or when you talk to Michael. But when you go talk to this audience, they don't want your ego all over them. They don't want to know that you got 17 PhDs and stuff like that. They want to know what you're really doing. And we've analyzed over 300,000 offerings. That's the data set that we have. And I got to tell you, the successes and the failures, it's all related to the CEO. And here's some other instances, statistics. Women are more successful at it than men. And the reason for that is because, yeah, she's right there. And she's right, because women have the instinct to build community. It's all about building a community. And they've had to look at how far they've had to work to earn the right to be at the table, at the boardroom. That's where I came from, where women weren't given the chance to be in the boardroom in the public companies, and they had to make room for them. How crazy is that, right? So this is they always understand that. It's like building a family or friends. So they tend to do better at it than men. They tend to better communicate. And that's the other element. You need to be a habitual communicator. Habitual.
Understood.
So that's it.
Let Carolyn, do we have any good questions? Can we open it up for some questions? Welcome.
Yes. Let me see. We do have a few questions that have come in. And actually one kind of related to something that Oscar said earlier. So Raphael asks, what is your experience with international cannabis company investments? And what do you recommend for companies outside the US to have access to American investors? And Jean-Philippe was also asking a related one as it pertains to Canada.
You know, if you're a Canadian company, as I am Canadian, jump ship. Seriously, US has 2 regulations. So if you stay as a Canadian company, you can use 506C rule, but you'll be limited only to accredited. But if you use the Regulation A rule, which the regulators in the United States allow both Canadian and US-based domicile corporations only to use it, you can raise up to $75 million from the general public. And by the way, that example that I gave you with the 1.2 million punks, that company originated from London, UK. It is the darling of the Regulation A+, and it's not even an American company. It is now, of course, because it needed to become an American company. And if you live in Columbus, Ohio, or if you live in Denver or in many other cities, but in Columbus, Ohio, BrewDog has a hotel that you go and you say, and the beer comes in a straw directly to the bed. That's BrewDog.
Great. Any others, Caroline? I think I see one in the chat.
Yeah, there's a couple. There's another one from Assad. He asks for more input regarding, he said he'd be grateful for any advice or guidance that they can provide on how to best present our business and investment opportunity to potential investors like yourself. Would it be okay to pitch to you on the emails given, or do you prefer some other way? So that's kind of opening it up. I'm not sure how much.
I think
individual pitches.
We'll all have different points of view. Maybe Michael can speak, then Jen, and then I'm happy to talk.
Mhm.
Like how, because we all want to be approached slightly differently.
I'm happy if you want to email me a one pager or a deck, and we'll take a look at it.
And I have a website for the Cannabis Syndicate. It's cannabissyndicate.co. I'm really not a marketing person, not my strength. But on there, I have a page for companies specifically. It kind of says like what we're looking for as a group. And there's a place where you can upload your deck or a one pager or a summary there.
And I think my email's in the chat.
Yep. I shared there.
For us, it's info at arcviewventures.com. What I like to see an email that really bullet points the highlights. 3 things: what the business is, what problem it's solving, how big the opportunity is, TAM, if you will, and then a comment about traction. And then a deck, really concise, that really makes me understand what is unique. And yeah, I mean, that's what I got to come away with when I get to that deck. And then if there's interest, we have a whole process, which then starts. It takes a period of time. But that's, I think, the best way to approach us. Okay.
And I do have one other question that was really interesting because it starts to fold into the political arena, which we haven't really wanted to touch on, probably.
Subject for another webinar.
Right. Well, his a quick question that maybe can be answered quickly is, when raising capital for a state with massive potential but currently in political limbo, such as Virginia, how do you present your plan or infrastructure to investors when the plan is contingent upon legislation?
I would say you say that the plan is contingent on legislation.
And don't send us that presentation, because that's not where we'll be focusing.
And I would say if you file with the regulators and they approve you and they don't, to them, it's a risk of any business. Look, I am an entrepreneur, so what business doesn't have a risk? If it's not licensing, if it's this, it goes one way. 7 years ago, I took a risk, to give you an idea. And the risk was that I said the regulators would go this route regarding blockchain, but 99% of the world was going this way. Do you see how difficult it was? But guess what? In December of 2022, I got vindicated. The regulators did go this way, and the other 99% are following. So I'm a little different than everybody else. I'm not an investor. The only thing that I do, if the company gets qualified by the SEC, you file your documentation properly and you submit. They don't vet your business in. They say, let the market decide. And yes, and Michael has every right to say no. That is true. But there are 4.7 billion people around the world. That's one. There's 233 million Americans. That's number 2.
Those are your potential investors.
They're your potential investors. That's it.
Hey,
Oscar, I would agree. I think the most important thing is to disclose the risk factors.
Yes, sir. Of course.
There's lots of ways that you can structure to address something like that. But most importantly, it's disclose the risk factors that you see. And quite frankly, disclose issues and risk factors up front. It builds trust and with your investor base and credibility. And if it's an issue, better to know up front than to get further down the road and then it comes up and everybody's wasted a lot of time. In fact, I found issues that an entrepreneur thinks is a risk factor, that when we look at it, we don't think it's a risk factor. or we have a solution to structure around that issue. And the fact that they brought it up front brings a lot of credibility. A lot of credibility.
Yeah, I agree with that.
Good point.
I do.
Listen, we're just about out of time. I would have asked everybody for one don't comment. We're not going to have time for that. Let's, although we do, look, we value input from our community. So let's put up one more survey, if we could do that. Let me just say, look, terrific. I mean, thank you, these incredible panelists. I mean, all of you approach this a little bit different, and you've had different experiences and represent a different part of the funding ecosystem. So thank you for spending time with us today. Thank you for your contribution. It's very insightful. Let me also just again thank our strategic alliance partners for making all this possible. We will add this replay to our library of programs on our website later this week. And please stay tuned for upcoming live and digital programming. And let's also just put the contacts for our marketing services, our consulting, and our venture group also in the chat if we can. And feel free to reach out to them to help you navigate the choppy waters of this cannabis industry, because they are choppy. But again, thank you, everybody. Thank you, panelists. And we will see you soon on our next Arcview Access. Have a great evening.
Thank you.
Thank you.